Gentlemen, I hope you had enough time to grab a coffee and a pastry and are ready for the next. We've got 2 sessions now going up to lunch. Obviously, we've got this one, which is emerging markets. Then in this room after this session, it's going to be global sector allocation. Again, it's a breakout session, so there is a choice. If you would rather go to the commodities session, this is not this 12:10, then that's in the other auditorium opposite, walk through the coffee and on the other side. But I'll remind you when the time comes. So we're going to kick off this session and run through till just after 12 o'clock, talking about emerging markets. I'm delighted that the panel, as you have struggled through this ghastly weather, to join us today. Nearest me is Diana Choileva, Chief Economist, Inodo Economics. Tom Miller next to her, then Adam Wolf, and on your far left, Christopher Granville. So many thanks to all of them. We're not going to be covering every single emerging market that there is for obvious reasons, but I do want to encourage as much discussion and interaction between the panel and yourselves. So far today we've had lots of questions. I've been really delighted by that, so keep them coming. As before, I will open the floor sort of officially to questions, but if there is something that you really want to jump in on, please don't be shy to put your hand up or shout out within reason whilst we're chatting, because we do want this to be as informal and productive as possible, and I'm certain that there's probably as much expertise in the audience as there is on the panel, so we're very keen to hear your opinions. As before, we're going to kick off with short opening statements, if you like. They have promised me that they really are going to be short, so we can get into the nitty-gritty of the discussion after that. I'm very glad that Tom has volunteered to kick us off. So, Tom, give us your opening thoughts.
Sure, thank you very much. I haven't actually prepared a statement, so hopefully I won't bang on for too long. If I do, tell me to shut up. So I would like to talk about China and India today, and I'll try to say a little bit about both. Very briefly, I would say that in terms of the business cycle, they're in quite different places right now. China is sort of slowing at the moment a little bit, but basically I think it's going to be okay. So you have housing slowdown, construction is slowing a little bit from where it was, but inventories are still quite low in China, so that should be okay. And I think that overall the markets in China will be pretty positive this year. I think India is sort of the opposite. The business cycle is picking up a little bit at the moment. We saw the Q3 data come in the other day. Q3 in India is October to December because the fiscal year runs to the end of March. But I think that markets in India are going to do less well than in China over the coming year. Equities are rather expensive. The bond market yields have been ticking up, I think 130 bips in the last 7 months or so. With inflation is also reasonably high at the moment and going up, so I don't think we're going to see any fall in the bond market there either. So I think that's a sort of broad overview of the markets. But I think what's much more interesting, frankly, at the moment is to talk about politics in China. I think certainly if you're a China watcher, which is what I am, I'm less of a markets guy and more of a sort of China guy, if that makes sense. I think the most interesting news that's come out of China in the last few months is certainly, what's happening at the top of the Communist Party and what that means potentially for markets. Obviously, in the last week or so, we've heard that Xi Jinping has decided to get rid of fixed terms in terms of the presidency. I think it's very important to point out that actually in Chinese terms, the presidency is nowhere near as important as being the general secretary of the Communist Party or actually being the head of the Central Chinese Military Commission. But what this shows us, though, is that that Xi Jinping's consolidation of power only continues, that he's trying to sort of bend, if you like, the constitution to his will, and that he really wants to use institutions to get things done. There have been a lot of comparisons between Xi Jinping and Mao Zedong. I think those comparisons, there are similarities there, but I think in one important respect they're kind of opposites. Mao Zedong decided to almost sort of get rid of institutions and do things his own way entirely. what Xi Jinping is trying to do is to use institutions to get his own way. And this is really about strengthening the party's grip over the state. And I think we're going to see some interesting changes at the National People's Congress, which starts next Monday. So we're going to see some new bodies introduced. One of them is the new Financial Stability the new Financial Stability Commission. Even bigger is the new National Supervisory Commission, which is really taking the anti-corruption campaign, which was focused on the party, and moving that into the government apparatus. What does this mean for markets? Well, in some senses, you could say that more stability is a good thing. Xi Jinping is positioning himself as the leader of China, well beyond 2022, 2023. Markets like stability, and you could say that the more powerful Xi Jinping becomes, he's bringing his own men into power with him. Liu He, who is his chief economics advisor, is likely to become the vice premier. He may even take over as the governor of the central bank as well, and he might be leading economic reforms. And the more power that's held at the center, the more economic reforms potentially you can make. There'll be no problem about trying to boost growth ahead of a changeover in personnel in 5 years' time. So in that sense, it could be positive for reform too. But I would say that that's unlikely. So far, Xi Jinping and the guys around him have shown no signs of wanting to make big economic reforms. And I think we may see more of the same. And this really is about state control. So if you're somebody who wants to see a big liberalization in China, I think it's unlikely. I was listening to the panel earlier this morning, and people were talking about, the chances of, say, the renminbi becoming an international currency. Obviously, this has been something they've been pushing for some time, but actually, in the last few years, it's something they put to the side because they were worried about capital outflows and other things. But I think if you want to understand China, the most basic point is that it is run by control freaks in every aspect of society, whether it's politics, whether it's culture, whether it's economics. And I don't think under Xi Jinping and the current administration that you're going to see a big relaxation there. And that includes on the currency. To bring it back to markets, as I was saying, I think that the economy, it's slowing down slightly, but it's all looking pretty good for the next year or so. I think economic fundamentals are not bad, and that Chinese equities are reasonably cheap compared to some other equities out there. For example, compared to Indian equities, and I think they'll do pretty well. And I'll shut up there. Thank you.
Lovely, thank you. Dan, I'm going to come straight to you, because obviously this is also your area of expertise. Do you share Tom's, I guess this was doing it like an end of school or end of term report, could do better, but doing pretty well. Do you share that sentiment?
I share some of the sentiment that he talked about, in particular the fact that they're control freaks and that we are unlikely to see further liberalization. In fact, 2015 was a critical year from that perspective, so we actually had 180 degrees turnaround in terms of policy. But what I wanted to open with was the three things that surprised me last year and one currently. So two from last year and one at the moment. The first one was the strength of consumer spending. At the start of 2017, my view was that consumer spending was buoyed by the robust housing market. Property transactions have shot up and house prices were rising, but then the authorities had started tightening, and my expectation through 2017 was for continued tightening, so I expected that to impact consumer spending. However, that didn't happen. So I started asking myself, well, what's going on? Because there's one thing, very few things actually, that Chinese and Western policymakers agree on, and one of them is the need for the economy to rebalance towards consumer spending. And what my analysis has shown is that, and it explains why China did all right last year, they managed to start rebalancing. It's really clearly visible now in the numbers, and it's come from two unlikely structural forces. One of them is demographics. At the end of the day, they're often talked about in negative terms, but actually, the migrant population has been shrinking for 5 years. Now the overall the migrant population, but the labor force now is shrinking as well, and that has pushed up the wage share in GDP. So households are able to take home bigger chunk of the income pie, and that was always a major structural imbalance to consumer spending. The other one is the other structural reason, sort of typically Chinese, and I cannot but not use the word remarkable supply-side transformations, where they, in the last 2 years, unleashed productivity and e-commerce in the rural space. So we have it both ways. Consumer goods are now reaching the rural consumers, and their untapped spending potential has been realized, but also farm products are reaching urban consumers, and that has explained to me one other puzzle that I was puzzling over last year, the fact that Chinese food price inflation has diverged visibly over 2 years from global food price inflation. They were very tightly correlated. So that's the consumer side story, and we can discuss later whether this development has further to go. The other thing that surprised me was that the authorities actually began the debt reckoning and began the de-risking that they are focused on, and in particular they tightened the interbank market. And the data just came out on Valentine's Day, but I guess, they have their own day of the lovers, so the PBOC wasn't celebrating. They love publishing the data, as in when you don't want to have to deal with Chinese data. And in the interbank market, we've seen that it has shrunk borrowing and lending, interbank borrowing and lending, quite visibly from what was an amazing expansion in the last 2 years. But what we didn't see last year was any pips squeaking. So that's very interesting to me. We had a bit of volatility in terms of interbank interest rates, but not really anything major. Now, the majority, so what has happened, the data is by type of institution, is that we've seen small and medium-sized banks, which were the borrowers, they stopped last year. The big banks continue to be the lenders, and the bit that hasn't come down by much is the other non-bank financial institutions, where, of course, it will be that much harder. So the one thing is we don't know what happened with the small and medium-sized banks. We don't have the data. And the other bit is more tricky for them. So one of the things I worry for this year, and we've had a lot of news reporting since the start of the year that Xi Jinping will go in his vein of control with the anti-corruption drive through the financial industry to make everyone toe the line. And if I had to worry about one thing unsettling or causing the de-risking process to cause risk in general, that would be one of them. And the third surprise, very quickly, and I'll end up with what you mentioned at the start, was that at the start of this year, we asked our clients, what is your top China question for 2018? I've been doing this for many years in various guises at different companies, but I love that sort of start of the year question asking. And what surprised me was that there wasn't a single question, and actually we had quite a sort of big turnout of questions on average compared with the past. There wasn't a single question about the yuan. And what I've seen in the data is, first of all, export sectors in China are struggling. They're really struggling. Second, this internationalization of the renminbi, which is a cornerstone of their future long-term strategy, has gone down. Actually, trade denominated in renminbi as a percentage of overall China trade fell to 12% last year from 27% at the peak in 2015. And we have the real effective exchange rate appreciating again. So my advice is watch carefully the exchange rate space.
Brilliant. Thank you very much. Who should we go to next? Adam, why don't you kick us off with your area of expertise?
Well, I think just an overall EM picture, the environment right now for EM assets is very favorable in the sense that we have a synchronized global expansion, which looks like it should continue at least through the first half of this year. And we have a situation in which global trade has finally come back for the first time since the just immediately after the global financial crisis, where exports are rising faster than global GDP in nominal terms. And that means that there are flows moving to EMs, and that helps to create an environment in which the dollar is on a trend depreciation path. And when you have the dollar depreciating, you have global trade expanding at a relatively healthy pace. EM assets tend to appreciate. So we like equities, we like the bonds, and we like the currencies. The things that could upset the apple cart, or the risks that we see on the horizon, are primarily US Treasury rates, that right now the 10-year Treasury yield is more or less in the fair value, where if the Fed tightens monetary conditions on the path that it has implied that it will, then the 10-year Treasury is fairly valued and should just gradually appreciate from here. And in that environment, EMs can continue to do well and continue to outperform other assets. But if concerns are raised about that tightening path, if the Fed looks to be slightly more hawkish, if we have a series of inflation prints in the US that are relatively high and that pushes 10-year Treasury rates up sharper, well above fair value, that's going to cause negative implications for capital flows to EMs, and that would be a problem for EM assets in general. And then I think the other big risk is China, in the sense that our baseline forecast for China sounds like it's very similar to what Tom was talking about, that we have the property cycle is kind of most of the cyclicality in Chinese growth comes from the property sector, because you have a relatively stable consumer demand. You have manufacturing investment just in structural decline because of this longer-term rebalancing process in China. And infrastructure investment since 2011 has just been steady at 20%. So most of the variability in demand comes from real estate investment in China. And we're in a unique down cycle in that real estate cycle in China, in the sense that, unlike the previous episode, unsold inventories for property are relatively low. And within China, you're seeing a desynchronization of the property cycle across city tiers and across geographies as well. And so the aggregate means that on the demand side, we've seen a very, very slow drawdown in demand. And on the supply side, that response to the weaker demand has actually been weaker. So our baseline forecast would be that continues, a gradual slowdown in China that's basically offset by stronger demand in other emerging markets and developed markets. But I think the risk is that you have a political situation in China in which you have not just Xi Jinping clinging on to power indefinitely, but I think the bigger risk is that you have the central bank governor likely to step down in the next few days. You're going to have a new top financial regulator in place. And typically the pattern is when you have new financial regulators, they try to make their mark and they act aggressively early in their tenure. And so the risk is that policymakers will look at last year and say, look, we've de-risked the financial system at the margin. We've implemented this slowdown in property prices and everything seems to be working. Let's push a little bit harder this year. And we could hit a tipping point in which you have at least a temporary policy mistake where credit growth or credit conditions become too tight to support that gradual deceleration phase that would be our baseline forecast.
Lovely. Christopher.
Thank you, Daisy. Good morning, everyone. Well, just to begin by glossing Adam's strategic overview of EM, we at TS Lombard will certainly share your bullishness on the asset class. This is a really fabulous period for emerging market assets for the reasons Adam mentioned. And I'd just like to gloss the risks that our global strategists are of the view that the global markets are suffering from hypochondria. They're thinking that they're ill or about to get ill because the cycle is so long in the tooth, so the conventional wisdom goes, but that's where they're wrong. We think that the cycle, especially in the US, is quite young. A proper cycle is only just beginning. And I think the counterpart to the risk Adam mentioned of overreaction by the PBOC in China, with a new leadership coming in, would be the Fed getting over-enthusiastic as real interest rates rise, as they should do, with a proper capex, pricing power, productivity, pent-up productivity gains being unleashed in the US and across the global economy, starting with the developed world. Real interest rates should be rising, and this will be good for EM. If central banks, having like a frustrated hunter looking for his quarry after such a long wait, finally spot it and get overexcited, what is that quarry? Well, it's the Phillips curve, and they think that there is risk of excessive price rises and overheating and overreact. Well, that could be complicated, and it would the natural jumpiness of markets, that hypochondria which we've seen on such dramatic display in the month just ended, there could be further bouts of it. So the hypochondria, risk of central bankers overreacting, it's going to make for choppy waters. So, but remember, the last boom time for EM before the global financial crisis was also characterized by intermittent squalls, very violent. While they happened, lasting a week or two, typically in that period, 2004 to 2008, it seemed that the world was ending, but then everything started up again. So in that environment, where obviously your returns on a volatility risk-adjusted basis will be jeopardized, what to do in EM? Well, look to fundamentals first and foremost, and to country selection. And the rising tide won't quite lift all the boats. We haven't spoken about India, though I know there's expertise much greater than mine personally on the panel, which I hope Daisy will get back to, because certainly we'd have a negative view, for example, on Indian assets at TS Lombard. But if I can just conclude this sort of opening salvo with a couple of remarks on markets that I personally know well. They're in EMEA, Russia and the former Soviet Union, Turkey, Middle East, South Africa. I can't resist, from my perspective as a Russia expert, if Tom's a China watcher, I'm his counterpart on your panel this morning, ladies and gentlemen from Russia, that comment on China from that perspective. I've always been telling investors a view of Russian political risk by way of unfavorable comparison of Russia with China. Look how wonderfully, I've been saying these past few years, China has institutionalized a predictable and steady rotation of leadership. Despite being organized politically on Marxist-Leninist lines, taking their example from the Soviet Union. And how much preferable that was to a very personalized version of authoritarianism in Russia, with a lack of transparency about the succession of power and not only the smoothness of it and the risk of power struggles getting out of control when the moment finally comes, for whatever reason, be it only biological, but also the drawback of a lack of regular rotation in not being able to generate political capital, to overcome mistakes, to find the political grounds to move policy forward, to blame more or less implicitly or explicitly the outgoing leadership and to overcome problems that way. So in the long run, this looks to me from a Russia perspective very negative for China, but not at all impairing the very constructive or broadly constructive short-term view you've heard from our China experts on the panel, and which certainly in my firm we would agree with. But otherwise on Russia, despite that succession and fundamental political risk problem not having been solved, and on the contrary, very much continuing as we speak, with President Putin launching his campaign this morning with his annual State of the Nation address and showing up on a massive screen behind him as he spoke, wonderful new military gadgets which the rejuvenated Russian military-industrial complex has come up with. Talk about saber rattling. But in fact, on economic policy, Russia remains a fundamental dream case. And I just want to leave you with a couple of things. The first is that by a brilliant piece of technocratic reform, which I think is not widely understood, not sufficiently well understood by market participants, the economic policy team in the Russian government has managed to decouple the Russian exchange rate, the ruble exchange rate, from the oil price by the application of a new fiscal rule, whereby surplus to forecast, excess to forecast oil tax proceeds are recycled into the domestic FX market to prevent the exchange rate appreciating and a recurrence of the symptoms of the so-called Dutch disease, which have crippled the Russian economy during the great oil boom of the previous decade. This is a fundamental breakthrough. It's tremendously positive for the public finances, for monetary policy, and also for markets. It creates a liquidity boost, reinforcing the effect of monetary easing. So you've got sustained fiscal spending increases on the non-oil tax proceeds above forecast can be spent, whereas the overall deficit is reduced. You've got monetary easing with a huge potential to go, with inflation now rock bottom, 2 percentage points below its 4% target, and real interest rates still at almost Brazilian levels. And you've got a liquidity boost coming from the fiscal rule. This is really tremendously positive, and the economy will grow above potential this year, and the long-term economic outlook is extremely mediocre, but largely for demographic reasons, but nevertheless in a positive EM environment, very positive outlook for Russia. Turning if you contrast on the second point I'd like to mention, which I think you may not have heard so much about in the sort of general investment conversation, if I can put it that way, widens the scope from Russia to the Middle East, particularly Saudi, but other petrostates as well. So I mentioned that the Russians have decoupled their exchange rate from the oil price. But the first building block for that breakthrough, of course, is to allow the currency to float freely, which any open economy would be well advised to do, especially one which is dependent on commodity exports, which by their nature are subject to highly volatile global price movements. Well, the problem with the Gulf petrostates led by Saudi Arabia is that they are hooked on their pegged exchange rate. Which will be ultimately the undoing of them in conjunction with the need to finance whole social systems off the oil rent. So, in effect, Russia is now, for geopolitical reasons as well as for economic reasons, in hock with Saudi Arabia in trying to support the oil price by restraining production and therefore stave off the threat from the US shale oil supply. But Russia could abandon its Saudi partnership and compete on price with shale. With its flexible exchange rate, the upfront hit, although palpable, would be manageable, and it could increase its volumes and increase its market share in the global oil market. That is potentially a big change to look out for. I'm not predicting it, certainly not for this year. It could follow further geopolitical shocks in the Middle East. I throw that out for you as a taster. I'm sure perhaps we can get back to that in discussion if that's of interest. Very last point, if you're looking to be guided by fundamentals in this bullish but choppy environment for the EM asset class, then of course Turkey would be your red light, your red warning signal. I was struck this week by the economic advisor to the government, Çağrı Ertem, respond to IMF criticism of the Turkish economy as in danger of overheating by saying that the IMF are in league with terrorists. And contrariwise, South Africa, which has showed the benefits of leadership rotation, a little bit chaotic, but nevertheless, according to the rules of the ruling party, the ANC, with very positive results for the currency, as you've all seen. and for the country's assets more generally, despite, again, as in Russia, a distinctly mediocre medium to longer term growth outlook. But of course, GDP doesn't predict investment returns. So along with Russia, South Africa also a very interesting market for you to look at. And if you're interested, we can get back to that now, but probably quite enough by way of an opener.
Perfect, a real sort of trot around the globe. Obviously, we haven't covered every corner of the globe. We couldn't possibly. Before I pick up on a few of those questions that have been posed and subjects, I am going to open it to questions now, because I'm sure that there will be specific areas that you would like to question the panel on, as they've sort of set out what their own areas of expertise are. I'm sure that they're all perfectly capable of saying that's not my area if there is anything that you want to pose at them. But we'll see if anybody's got some questions. We've got, is that a hand up? Is that Anatol? I can't see it. Is that Anatol? Oh, if we could get a microphone to that side of the room, that would be terrific. I'm guessing we've probably only got one microphone now. Perhaps the other one's gone over to the other room. Love it. I was very interested in all of it, but yeah, the sort of Saudi-Russia angle was very interesting. Also, for anybody who wasn't here, I think, Tom, you said you were here, but there was a show of hands about confidence in emerging markets, and it was overwhelmingly confident. I think there was one person who said they weren't confident, and I think I can remember who it is, and I think they're in the room. So if they wanted to tell us why they were the only one that said they weren't confident earlier, that would be very interesting as well. Anatol.
Well, I actually wanted to follow up on the Saudi-Russia issue because I thought that was fascinating, Christopher. And I have a specific question on that, which I think relates to your long experience as a diplomat and so on as well. Do you think there are, in the medium term, there is a difference in strategy potentially emerging between Russia and Saudi Arabia on the oil price, in the sense that for Russia, the long-term ability to sell large amounts of oil and maintain or increase its market share is important, because the Russian government has a long view about the future of the country, which they can also now reconcile with the short-term issues for the reason you gave. Yep. In Saudi Arabia, on the other hand, with Mohammed bin Salman, they've moved to a very, very short perspective, in that he is running a revolution. He needs to maximize revenues over the next 2 years, or he's going to be dead. And therefore, Saudi Arabia, although it has all this oil, no longer has the concern about maintaining market share that it had in the past. Now, that creates a situation where Russia could go to increase its market share, as you said, at the expense of Saudi Arabia, which also helps Russia in the geopolitical competition between themselves and Saudi Arabia in the Middle East. So could there be a serious cleavage between those two key partners in the OPEC cartel?
Thank you, Anatol. The answer is yes. You articulated it better than I managed to do, for exactly the reasons you say. And thank you for reinforcing my attempt to flag up this area as a fascinating and potentially very important change. I allow myself one gloss, that this potential divergence, which we agree on, would be very much in Russia's interests. Russia should prioritize volume over price. It has the ability to do so. It is rational. Global demand for hydrocarbons as this century progresses will decline. If you've got them, you should get them out and sell them while you can. And if you're very orthodox in fiscal and monetary policy like Russia is, you would save a good part of those rents, exactly as the IMF doctor always prescribed. However, what is, I think, going to hold back this natural and beneficial advantage, which if it happened that if Russian assets sold off of it, that would be a huge buying opportunity, by the way, in Russia, is, I think, Putin sacrificing economic rationality to short-term geopolitical interest, just as the Saudi economic interest is very short-term, exactly for the reason Anatol said. Putin is constantly juggling short-term geopolitical calculations. Russia's path back to the global top table is through the Middle East. Russia is positioned now as probably the most important arbiter at the center of the Middle Eastern nexus, on speaking terms with everyone on all sides of the barricades, including the Saudis, who are on the opposite side from Russia of the central barricade of the Sunni Shia sectarian tension as blowing up all over the place, but of course most tragically of all in Syria. And effectively displacing the United States as the pivotal arbiter in the region. Remarkable fact, if you think about it. And Putin is very focused on that, and keeping his oar in with the Saudis is this oil output restraint gambit is the key lever he has. And actually this is less than rational for Russia economically, but won't easily be shifted. And very likely some new geopolitical blow-up in the Middle East will be the trigger. So there we are.
Thank you very much. Any further questions either on... Oh, and very good. If we can get the microphone to the front. And Sarah, I know you were asking about China in one of the previous sessions, weren't you? So I'm going to bet money that this might be China related.
Quite right. Yeah, hi. This is about the Belt and Road, so there's a bit for Tom in there. I work with Tom, disclaimer.
It's a patsy question.
But there's also
Planted
a bit of
question.
Africa in there, and that's for Chris. It's fascinating what you've just described. Specifically on China's infrastructural investments in Africa and the appetite for resources, in particular oil. Do you see any potential friction, or how would you place this within your framework when we see that the Russians have actually moved into certain African countries recently to invest as well? So yeah, just a twofold question. One, general thoughts on the Belt and Road and how that's playing out into oil in Africa, China versus Russia.
Well, I haven't got any very original insight on this, I think, I fear a slightly well-worn question about China's gigantic economic engagement in Africa. That is gigantic for Africa, minuscule for China. And perhaps fellow panelists can add something to my rather general remark. I would say that there's no conceivable rival for China as a strategic investor in Africa. The Russia nibbling at various corners in mining in Western Africa, in nuclear in South Africa, which may be stopped now, are just that, extremely marginal, and the same goes for all other players. And I think that if you're exposed to African markets, the key risk factor for you to be aware of as investors is the case-by-case, country-by-country backlash or continued fruitful engagement with that Chinese inward investment and the macro policy handling of those flows. So I think it's just a fairly boring answer. It's a case-by-case thing. But it's a very central topic for all African investing. And I guess that on the wider Belt and Road, I think I really will have to hand over to our Chinese specialists. But I think that again, I would stress how modest this is for the in terms of the recycling of Chinese total savings, however important it may be for individual countries, of which perhaps Pakistan is the single most important recipient.
I'm going to get Deanna to respond first, and then Tom. Tom, I think you've written a book on this subject, and then I have other questions to ask, general questions. Just a quick show of hands for any more questions that are. Lovely. If we get the microphone to the gentleman there, and I'll hand over to Deanna first and then Tom.
What was the question on the Belt and Road?
Progress.
Progress or impact, or both? My view on the Belt and Road initiative is that it's in line with China's long-term strategy of moving towards severing the link with the dollar and creating regional influence, allowing it to become self-sufficient. It certainly is not sort of trying to export its excess capacity all that much, and it's certainly not helping in growth terms in any shape or form China's development. It is very much a geopolitical initiative that is China's basically trying to escape its very restrictive geographical position. What's interesting is that the various stans, Kazakhstan, actually Kazakhstan not, but the other ones, Turkmenistan, and yes.
Not doing very much there, actually.
They are resisting it, though. They are not happy to get neither Chinese investment, nor Russian, nor Turkish, for that matter, because, you know, we all know that this comes with particular requirements. China has learned that it's a very good idea to have those that it wants to influence to be her borrowers, so it lends to them. And I'd be more interested, I mean, I'm sorry I'm talking with this sort of down tone about it, but in all honesty, I just don't find the Belt and Road question particularly interesting. There's so much more that's going on that I think will have much bigger implications for markets, both this year and over the next 2 to 3 years.
It's not an investment theme, is it?
It's not an investment theme, but I mean, it's part of the geopolitical story. It's an important part. Not everyone's keen on China. Probably the relationship between China and Pakistan is the most important to watch in this, because the main clash there is in Asia is China versus India.
Tom, on this issue, and also because we did mention India.
Sorry, I
briefly.
said you wrote a book on it, and I said it's so not interesting to me, but you know, it is interesting clearly to other people.
So I'm going to get you to comment on that and how boring it is. No, I'm joking. And also on the India question, which Christopher also, just to flesh that out. And then we'll go to the chap who's got the microphone here. And then actually we had a question, so if then after your question, the microphone could go there. But Tom, the floor is yours.
Yeah, this is very hard because, as you said, I did write a book about it, and it's called China's Asian Dream: Empire Building Along the New Silk Road, which is available from Amazon. It's difficult to answer because it's so big and it's so complex, and it's really hard to know where to start. To be honest, but I think one place to start is to try to work out what exactly it means. Which is very difficult because, in a certain sense, you know, even Beijing itself doesn't really know what it means, and that's because there is an idea that, you know, this is about a series of projects which you can kind of tick off on a list. And yes, of course, there are projects associated with this, but it's more about a broad set of policy aims than it is about specific projects. And I think it's very important to remember that this is a very, very long-term policy. You know, it's about many things, but fundamentally it is about building infrastructure, and building infrastructure takes a long time, and what gets built will depend upon the vagaries of sort of deals made, often at sort of government to government level, but also often with sort of big state-owned enterprises in China sort of talking with foreign governments and foreign enterprises and doing deals, and they may or may not work. And in some places we'll see some big stuff happening. In other places we'll see deals made and nothing's going to come of that. So, and also this will play out over many, many years, maybe 10, 20 years. You know, it's a big, long-term policy. I think one other thing to stress is that you often hear a lot of crazy numbers out there. Don't believe any numbers you hear. They're plucked out of thin air, frankly. And you hear a lot about Chinese investments. Belt and Road does include Chinese investments, but fundamentally it's not about that. It's much more about Chinese financing and Chinese construction. It's about China particularly talking to less developed countries and saying, look, you lack certain things. So, for example, you lack roads, bridges, power grids, sort of fiber optic cables, whatever it may be. You don't have the financing or the engineering capacity to deal with this. Guess what? We have both. And of course, China has this stable of very experienced state-owned engineering companies that can go in and do that. And guess what? Also, it's got a lot of state financing behind it too. And really, the big financiers of this are the Chinese policy banks. And a lot is happening, right? You do see a lot of sort of skeptical reports out there. Often they look at the investment numbers. What you should be looking at really are the construction deals, which are very, very much higher. And I think this is a very big and it's a very serious project, but it's probably too early right now to say whether it's going to succeed or not. And of course, there are big geopolitical risks involved as well. Diana said it's fundamentally a geopolitical project. A lot of my book was about that, but actually, it's as much economic as it is geopolitical. Just for China's own development, initially, it's about sort of pushing China's sort of infrastructure push at home, sort of further onto China's borders and trying to develop underdeveloped regions of China and trying to build up connectivity with countries on China's borders and fostering, even creating markets there.
Now, I am dramatically running out of time.
Yes.
I haven't let you talk about India yet.
Okay, I'll shut up about that anyway. Read the book. It's all in there.
I'm going to take these two questions just in case there are other things that we can pick up on and then give you all a final...
Am I talking about India or waiting for the question?
You're going to wait for the question
Okay.
now. So, the gentleman with the microphone, perfect. If you could ask your question... Oh, no, we've not got the microphone. And then we're going to pass the microphone to the chap with the purple tie, sir.
So a derailer to our optimistic outlook is protectionism that's in the news and been mentioned today. So I'm interested particularly from a Chinese perspective, given it seems less correlated to global trade now and exports less important. Is this something that you think the Chinese will respond to? How are they going to act, given what's in the news now?
Okay, lovely.
I like that question.
You like that
And I
question?
answered.
We're going to hear the second question, and I'm afraid the last
That is an
question.
investment theme.
Lovely. And then I'm going to give you each your Jerry Springer final thought of the day. So,
You may choose not to want to answer the question, but it was going to be about Korea and its effect. So if I'm allowed to ask a Korean question, I'm very happy to do so.
you can ask any question you like, within reason.
In the event, I'm not going to suggest whether it's probable or improbable that all of a sudden peace breaks out and the Koreas unify. Trying to exclude the political effects, which obviously are significant globally, what does the panel think the effects could be on the emerging market classes as a whole, and obviously specifically on China?
Lovely.
Obviously on Korea, but China's the main question there.
What I'm going to do is, from Diana moving to the left, a final thought from each of you, obviously responding to either or question or anything that the other panelists have said. Diana.
From a 10-year perspective, which is a very, very tricky ground for an economist to be on, trying to forecast the future out like that, for me, we are sort of experiencing tectonic shifts. What became clear since China joined WTO in 2001, and it should have become clear before the global financial crisis, certainly after the global financial crisis, not to everyone, but certainly to me, is that globalization as it is now does not work. And the West had tolerance with China in as much as it appeared that China was converging on the Western free markets, liberal, maybe not the politics, but certainly the markets. And that is now out of the window very decisively. Xi Jinping has turned around the direction of China's economy and politics on its head. He's thrown out almost all of Deng Xiaoping's ideas. So China's going to pursue its own way, its own sort of capitalism with Chinese characteristics, and the West doesn't sort of seem likely it's going to converge on communism, although who knows? I mean, we might sort of elect Corbyn here and have a little bit of a sort of experiment, but presumably then the democratic system will kick in. I don't know. I mean, as probably most of you know, I grew up in communism, so I'm not a big fan, if possible. So China's pursuing its own model, and so is the rest of the world, and globalization as it is does not work. So a trade war is a very clear, very likely event, which over the course of this year should be really trade skirmishes, because China it's not ready to fully stand up to the US, neither from the perspective of its military position, nor from the perspective of its economic transition. There's some incredible things going on in China's economy that are very positive, and I certainly was surprised by how successful they were with that going rural strategy, and that has further to go. Another kind of mini revolution is likely to go on in the rental market, which, everyone mentioned housing, but the real story is rentals, and that could have profound implications on how the economy operates. On the other hand, there are severe headwinds. The trade war is one. I think they'll try damage limitation, but ultimately, unless either system changes and tries to converge to the other, the global order as it is will not work. So I expect that over the next 10 years, we'll see the localization of the world and having, spheres of influence.
To move on. I literally have, I believe, our next panel waiting in the wings. So I don't want to be rude. So I'm going to literally just a minute or so each, which I know is difficult, and particularly if there is a market that we should be all looking at and investing in that hasn't been mentioned, I'm sure we'd all like to know where it is.
Can't say much in a minute, but I will respond to India, as you mentioned it. So I agree that the outlook for markets in India this year is not great. Whether you're looking at equity markets, bonds, or the currency. Everything's expensive or everything's overvalued, basically. The bigger question is, should you be interested in India longer term? Absolutely. I think the big question for investors out there is, can India take over from China to a certain extent as China slows, as it is structurally? And I think to a certain extent, it can't be the new China, but there is a certain kind of slack there that it can take up. And I think that the overall story in India is very much one of 2 steps forward and 1 step back. But things are beginning to move in the right direction. I think whatever you think about Modi's party and Modi's government, and there are many reasons not to be sort of particularly keen on it, I think that if you are looking for economic growth in India, it is the best option we have. And actually, the BJP and Modi's government have been putting in place some pretty important reforms. I spent a lot of time in India now, and I think that those reforms structurally are beginning to change things there. So keep watching India.
Lovely, thank you very much. Adam, just a response to what the other panelists said, obviously any questions you want to pick up, or any markets that you think we should be concentrating on?
I think that the shift towards protectionism from Washington is real. I think that it's not just, and the shift on Chinese policy to a more aggressive stance towards China is not just a Trump administration shift, that the consensus within Washington has shifted to more of a view that China's never going to evolve to become like a normal Western democracy, and that the support that they've been getting from the Pax Americana system should be curtailed in some way. And the debate is on how to curtail that. The Trump administration, from what I understand, has just already decided that they will impose strict protectionist measures. It's a question about timing and scale. And so Liu He from China is there today to try to delay that, to minimize that as much as they can. But I do think that something is likely to happen later this year in that direction. Obviously, that would be a negative for global risk assets, EM in particular. And it's a question of how negative that will be and when that will happen. And then I'll turn quickly to India and just say we're also very bullish on India. We actually like Indian assets to a great degree as well. India's had a string of self-inflicted bad luck over the past year and a half. But now it's recovering from the twin shocks of demonetization, the poorly managed rollout of the goods and services tax, recapitalizing the state banks, and then it turns out that they have $2 billion in fraud. The credit growth is picking up. Economic growth really is starting to pick back up in India. Some of the longer term reforms will be positive for the Indian economy going forward as well. And the bond market right now is priced for a fairly aggressive tightening push from the RBI that seems unlikely to happen, and that should provide a kicker later this year for Indian assets.
Final few seconds, Christopher.
Well, it's got to be seconds. I feel embarrassed, as you say, Daisy, with Andy and other panelists lurking behind you. So what can I do except agree and applaud my fellow panelists? The two great underlying risks in the world are the reaction against globalization, to go from the first question. You could simply say this is the mirror image of China in its great boom years after the 1990s, pursuing a mercantilist pursuit of job creation. America wants some jobs now, blue-collar jobs, and the localization phase, well, EM can participate in it through outward investment. And I think Chinese outward investment in America is a much more important investment theme than the one in Africa that we mentioned earlier. And the other big risk, of course, is geopolitics. The United States government has declared a new Cold War against China first and foremost, but also Russia. And to go to the Korea question, I was, after the annexation of Crimea, I was at a conference, I think Credit Suisse conference in Hong Kong, and I heard a luminary of the American think tank scene say that if Korea is reunited, the United States is not ready to concede a sphere of influence to Russia in West Eurasia, but it is ready to concede a sphere of influence to China in East Asia. Why? Because Russia is weak and China is strong. And on that taster of the wisdom of the American geopolitical community, I'll leave it to you. I think it's too sanguine. I think it would be extremely fraught and geopolitically explosive. That's my answer to the Korea question.
Thank you very, very much. Please show the panel your appreciation, ladies and gentlemen. And thank you for your questions. Just to remind you what's happening now, if you stay in this room, you will be witnessing the Global Sector Allocation session, which Andy Hartwell will be moderating. If you want to go to the commodities sector, then that is over the road in the other, just over the lobby in the other auditoriums. That's commodities over there, global sector allocation here. I'll see you at lunchtime.